Hey, Taylor, it's good to see you again. Oh, I think there's, two pretty big challenges for tech coming into earnings season. And, one was going to be just kind of pull forward of demand. And I think that's probably what, kind of caught Netflix up. And the second was going to be input cost inflation. And that seems to be what sort of bit Amazon. So, I think you had these two themes that even if you beat on earnings, those two aspects of the outlook were going to be really big challenges. And they certainly trip stuff up. And then second is just the macro impact of, high inflation, high interest rates, and tech, obviously a longer duration equity, so much more sensitive to that. So a little bit of a triple threat here. We are actually feeling much better about the outlook for tech, over the next few months. But I think around earnings, those are the things that have been the biggest challenge.
I'm curious, when you think about the Qs, are call options and asking about your trade here an easier way to dip your toes if you don't want to actually go all in and buy?
Yeah, I think it is. We talked the other day, Taylor. I think, this is kind of a three-step process, and we're probably a little bit early in the process in terms of re-engaging into tech exposure. So we do like a kind of risk-managed, almost more passive approach of owning 10% out of the money, July call options on Qs, just so you do have some exposure there that if rates turn, if inflation declines the way we expect it to, that you do have some kind of exposure in place. So something like Qs, July 350 call options, or something along those lines makes a lot of sense to us.
How do you think then about pivoting to the more defensive nature of this market? We're going old school. I mean, I was speaking with Gina Martin Adams, who was saying staples actually are starting to look expensive given the massive sort of input back into some of the staples. Does that make sense in this inflationary environment?
Look, I think people are definitely hiding in the more defensive parts of the market. I think, both utilities and staples are areas that seem to have outperformed quite a bit. We actually do like hedging in staples, particularly around earnings, and it really gets into that input cost inflation theme. Whether it's commodity prices or today we got, the employment cost index accelerated quite a bit in the first quarter. And we think those could both be challenges to the consumer at large, but also to the staples sector in particular. Earnings of volatility for those stocks was actually quite high last quarter. Nearly 6 in 10 staples stocks beat their options implied moves, which is pretty unusual for what's usually a quieter part of the market. So, it's an area that's outperformed quite a bit. We do think they're kind of in the crosshairs related to this input cost inflation theme, and we do think it makes sense at least to hedge that exposure and that outperformance around earnings season. Just something like May put spreads to reduce that risk.
Finally here, yields higher. That is the theme. It's been the theme for the year. Are you looking at that further continued path higher for yields?
Look, I mean, our view is that inflation has peaked, and over the next couple of months, you're going to start seeing, a gradual, but then after that, very steady decline in inflation. And from our perspective, that will allow the Fed to be a little bit less hawkish in its rhetoric, and frankly, should get, rates a little bit lower as the year progresses. And that's one of the things that makes us a lot more positive about parts of the market that have been so negatively impacted by that, large cap tech being part of it. So, look, I think, most people would say the path to rates is higher. For us, it does feel sort of fully priced with a lot of rates volatility. So I think simply getting some of that rates volatility a little bit lower, maybe taking the sharp edge off some of the Fed rhetoric, would just be really, really welcomed. And if that happens alongside a decline in inflation, which is, your previous guest was talking about, has been the number one kind of bugaboo for markets, we think that stacks up pretty well for risk reward to improve in tech and some of these other parts of the market that have lagged.